So Olga probably just said this, but I'll give you an ad for the remaining workshops here. So today we're going to do proformas, financial projections, for angel investors and for entrepreneurs. Tomorrow we do valuation. So we will demystify how to value a pre-revenue company, and we'll also talk about capital stack strategies and how to break up a company's strategy into multiple rounds to keep as much equity on the founder's side as possible. And then on the next day we will do term sheets and due diligence. We'll walk through some of the key terms that are negotiated, different types of deal structures and benefits and drawbacks of all of those. And it's not on here, but on Friday we will also do a workshop on how to bring a company to the US market. So that's what we have coming up for the rest of this week. So thank you all for coming today, and we will have this coming on later on. I'm going to change gears here a little bit. Okay, good. So let me just say this. Thank you all for coming. It's great to see some of you again and others for the first time. I am here to learn from you and to learn about the startup ecosystem in Macedonia. I have been learning a ton, and it is totally fascinating, the things that are going on here, and actually very exciting what I see. So all of you who have shared what you're doing, thank you. But to start off, we will do a quick introductions. We'll just go around the room if that's okay. And just a relatively short thing about your name and what you do. So it might be 15, 20 seconds or so. And we'll start here with you.
Igor Wyszewski, serial entrepreneur, co-founder of Impact Ventures and Impact Foundation.
Great. So everybody, that was the perfect amount of time. Good job. All right.
Hi everyone, I'm Ognjen Žulovski, and I do business analysis in yours company, Impact Ventures.
Great.
Alexander Sajewski, entrepreneur and incubator partner.
Great.
Violeta Mickoska, entrepreneur and economist.
Okay.
Hello everyone, I'm Alexander Umirovsky. I'm CEO and co-founder of Solar Data Collector and also co-founder of Community Business Incubator in Skopje.
Great. We'll move over to this table.
Nikola Volkovsky, co-founder and CEO of Howitzer, marketing tool for AI.
Great. And Olga is busy on her computer.
Yeah, I have
Yes, you did. Okay. All right. We'll go past you. Yes. Okay, thank you. Yeah, and thank you for hosting this event.
Eric Arsa, Crimson Capital, we're one of the co-founders of Diligence.
Great. We'll come to this table.
Dejan Krivikov, Managing Director of SDG Capital, a fund manager.
Great.
also
Okay, thank you. Travel in flocks, it's good.
My name is Tony Popov, founder and CEO of Futuram company, startup companies. Hopefully it's going to be successful after this support.
Good.
My name is Sanja Vitrovska. I'm a founder of Networker. I help startup, basically with my team. We run design sprints and also we help them raise funds. So that's why we're here.
Perfect.
My name is Vladimir Mitrovsky. I'm a student and also a practicant for Networker.
Miriam Shokovska, marketing specialist at Networker. Bojana Paczynska, part of Networker as well for marketing.
You?
Me?
Yes.
Hello everyone, I'm Ivana Maczewska, a co-founder and a product owner of Testing, a platform for automatization of predicting project management platforms.
Nice.
Mikhail Shteyev, co-founder of Syndex and 2D Game Studio, who developed its first title, Sidra, and is backed by Business Accelerator.
Boris Tomaševski, entrepreneur and involved in the development of beverages, brands and
Hi, my name is Darko Kazan. I'm financial analyst at the agency for real estate investing.
Great.
Marko Vasiljev, co-founder of Proformas.
Maria Grigeva, we are from Proforma as well as CMO of Mamaka and
Igor Mikovsky, entrepreneur, just starting
Okay. Thank you, everybody, for that. That was perfect. All right. For those of you who, I know Olga maybe a little background, I have been in the startup world for a long, long time myself. I run the oldest angel group in the United States. We've been operating since the early 1980s. And also run the Rockies Venture Funds, which is a platform for micro funds investing in pre-seed and seed stage companies. I'm also on the board of the Angel Capital Association, which is the professional association of angel groups in the US and throughout the world. And then, I wrote the Venture Capital for Dummies book about 10 years ago, and most of it is still pretty relevant. And we continue to make things better and better with that. So, let's talk proformas. This is so exciting, right? This is, financial projections. And I know this generally puts people to sleep, but with startups, the proforma is one of the most interesting artifacts that we have as investors for due diligence and as planning tools for startup founders. So just as a caveat, I will assume that you all, and from your introductions, I think I am pretty safe in this assumption, that you all understand basic financial statements and all of that, and we don't need to cover that. There's lots and lots of places you can find that information. All right, so let's just talk about proforma. And do you use the term proforma here? I mean, you do? Okay. I did this workshop in Australia and nobody knew what I was talking about, and they even speak English there. And it's interesting, if you type the word in Microsoft Word, proforma, it gives the red squiggly typo. It tells you that it's a mistake and you've done something wrong, which is odd because it's a word very commonly used. So with that being said, the way I think about defining what a proforma is in this context, of course, simply it's financial projections. But when I think about it more deeply, I think about it as a scenario in numbers. And when we are investors or we are startup founders, we are thinking about a startup that does something or has some asset, either software or a product of some kind, and it can be applied probably in an infinite number of different markets, different prices, different channels that it might be sold through, and each of those is a different scenario of the same thing, which are possibilities for a company. And so as I'm thinking about what startups should be doing, before they raise money, they should be doing this work and thinking about scenarios and working out which scenarios look most promising. And there is a lot you can do in numbers without touching on the real world, which is very expensive. So I like to invest in companies who've kind of figured this out and who are not going to just take my money and spend months trying to figure out what they could have done anyway. So the other definition here is, and this is the important part, researched and validated numbers. And people struggle with preparing proformas because they are future projections. It's one thing to show you past financials. That's very easy because you just look at all of your transactions, add them up, and there you go. Into the future, it is more difficult. So how do you do that? I will talk more about that, of course, today. But as a definition, we are talking about when we don't know what's going to happen in the future, we look at what other companies do, or we use various techniques, bottom up, top down, different ways of analyzing numbers, and I'm sure you've all done this, and this is how you get to something that is believable. But I will say this, that 9 times out of 10, when founders are presenting their pro formas to investors, there's sort of this uncomfortableness of, is this really real? Is this going to happen? But I will say that when I am analyzing pro formas, this is not scientific. I haven't actually written it down, but I would say maybe about half of the time, I more or less believe the pro forma. I believe it, and I will use it in my analysis. Other times, I have to start from scratch and recast all of the numbers and create my own pro forma. And of course, if I have to do that, I'm wondering, why am I doing this? Is this really an investable company? So it's good advice for companies to spend their time creating a believable pro forma. I'm going to pause for a second. Some of you have been in these workshops previous days, and you know that I had a ground rule that you should interrupt me as we're going through if you have questions. So don't feel like you have to wait until the end. I love being interrupted, so it is not rude. It'll be something that I will be very excited about if you have questions as we go through. All right, so here's the other thing about pro formas. It is just one part of a suite of planning documents. And this, if I say it, you'll go, yes, of course, they all need to hang together. They need to work and support each other. But I will say fewer than half of the sets of planning documents I receive correlate. So I will see a pro forma, for example, that shows a need for $3 million, and then I will see a request from a founder to raise $5 million. Well, given that venture capital is the most expensive capital in the world, why would somebody raise $2 million more than they need? And sometimes I get an answer like, oh, we wanted to have, some extra buffer. And I'm like, well, that's 66% more than you're projecting, so you obviously don't believe your pro forma, why should I? And so making sure these things all work together, and certainly a buffer is okay, but making sure they all work together is a good thing. So here is an important principle. I see so many people who they will say that this pro forma is conservative estimates, and that they will even say things like, we tried to make the numbers lower, but we just couldn't get them to go down anymore. And one notable company showed me something like $4 billion in revenues by year 5. And I was like, I can make those numbers go down. It was absolutely crazy. And they had the nerve to say that these were conservative estimates. And if you do the research, you'll find that $4 billion in year 5 is the largest, fastest growing startup in all of startup history worldwide. And that is somehow a conservative estimate. I was just going to say, so this company, interestingly, is still alive, and now it is maybe 7 years later, and they are doing $35,000 of business every month. So that is on what we call, in our investment strategy, we call that the walking dead. It is just not an investment you ever want to get into. So there is this thing. Certainly, 4 billion is possible. It may be 0.0000001% possible, namely impossible. But there's all kinds of things that are possible. That doesn't really matter. What we want to present is the probable. So what is likely going to be the outcome? And that is just an important distinction. All right, so let's just do a little nuts and bolts here. Let me ask you a question. How many of you have seen one or more pro formas other than your own? Okay. How many of you have seen 10 or more pro formas other than your own? Okay. So relatively few. And this is the normal distribution of answers, that there's usually just a handful of people who have seen a lot, typically people who are investors. Of course, you see hundreds of them. But if you go and Google for pro formas, you can find just about anything on Google. It's really hard to find good examples of proformas out there in web search. And so it's very difficult to find samples to sort of say, oh, this is what it looks like, and so this is what I should do. And there are some templates you can buy for $99 or whatever. They're horrible. But you know, that could be a place to start if you wanted. So this is what I think of is the core, the base elements of what should be in a proforma. So these would be tabs on an Excel sheet or Google Sheets sheet or whatever it is you use. And I put this slide up because a large percentage of proformas I get are just number one, just the income statement. And if I'm only going to get one, that's probably the one I want because I'm curious about how revenues and expenses are going to play out over the first 5 years. And this will tell me that. And from there, I can kind of make up my own balance sheet and statement of cash flows. But better to have all of those because I have seen people who do, for example, statements of cash flows where they demonstrate on their pro forma that they are going to run out of cash in year 3 to the tune of $1 million, but they don't show that they are going to raise money. And so it really becomes a very big red flag when you see people who are, it's fine to have negative profit in the income statement, but you cannot have negative cash in the cash flow statement. And so that's why I like to see all 3 of these. And then I will talk more about these specific strategies or products. Now, and this is where I'm not a template guy. I think the proformas are very, very unique to each company. So depending on what the company does, I might want to see things like a product pipeline. All right, you're creating product A today. That will take you through your first 18 months, and then you'll launch product B, then you'll launch product C, and you'll create a suite of products. Or not. Maybe you've got one product, and then that's great. But this would be one place where you could show the impact, financial impact of what percentage of each of those products are going to be contributing to your revenue. So I like to see that. I also like to see channel strategy, which is one of the biggest risks as companies think about how they're going to take their product to market. I like to see a channel strategy that says, well, we're going to start with selling on our own website because we want to be close to the customer and we want, and it's low cost and we get to keep all of the margin. So we're going to start that way. But after 6 months, then we'll start, you name it, selling it on Amazon, Shopify, through affiliate marketing relationships in Walmart, whatever it is. So the other thing I like about seeing a really good channel strategy is that there are channels that will open up to companies once they hit $5 million or $10 million in revenues that don't exist for them as a startup. So a lot of these channels will not take the risk of bringing on a product at that early stage. So I want to see somebody who doesn't just think about 1.0 and then project that out for 5 years. I want them to say, oh, well, once I get to 10 million in revenue, then all of a sudden these other avenues open up for me, and I will be, this is how I intend to scale and grow my company through these additional channels. And then, another one might be marketing. Just talking about what events or what means or people or whatever, just breaking it down, because marketing for startups is one of the biggest line items. And if I see a pro forma and all I see is marketing, there's a lot in there. And so I want to see that broken out because that is one of the risks I am most worried about. Okay. Here's another way to think about when you are starting to design a pro forma, and that is you probably are working with an accountant, and if you're not, my question is, well, why not? If you have a company, you ought to be doing accounting from day one. And I've had some companies tell me it's too much work and a distraction. Well, that just makes you uninvestable, if you ask me. So once you start having accounting, which should be from day one, then you, of course, will need a chart of accounts, regardless of whether you're using QuickBooks or something else. And interesting enough, if you can design your pro forma to match your chart of accounts, and then you can use your pro forma as a budget as you're going forward. Because invariably, I guarantee you, an investor will say, well, how are you doing compared to your pro forma? And if you may use the same line items on your chart of accounts, you can just say, oh, well, in fact, here we go. And you can show them. All right. So here's another thing that some people build into proformas. So I just talked about income statement, balance sheet, statement of cash flows, and other things. Some proformas will actually put in an entire tab just daylighting what the assumptions are. So they might be assuming, say, 1 or 2x year-on-year top-line revenue growth, or they might be assuming, 30% expenditure on marketing for the first 2 years and then dropping down. Or, but whatever those things are, if you do it on a separate tab, then one thing you can do as an investor or entrepreneur is you can go and change those numbers and really quickly see what happens. What if we went to 3x year-on-year growth? Or what if we dropped our marketing to 20%? Or what if, whatever, then that's a way to do that. I sometimes like it when that happens and you can do that, but the caveat is that assumes that you're programmatically building your month-on-month, year-on-year growth. And I think when people just say, January times 1.1 is February and February times 1.1 is, then that's where we get into trouble and we just can't make the numbers smaller. So the caveat is I like the assumptions, but I don't necessarily, while I like to play with them, I don't necessarily appreciate when somebody has programmatically built their top line. All right. Here is, if you have a physical product and you are selling it through channels, maybe through retail or Amazon or whatever it is, a classic rookie mistake I see over and over and over again is, well, maybe the strategy number one is producer and consumer. I know you can't read this, it's little, but, and by the way, Olga can send you all of the decks for this, so you'll have these to refer to later. But you might start here and you think, oh, well, I am doing great. I've got a 55% gross product margin here. So every time I sell one of my $100 units, I'm making $45. And indeed, when they sell on the website, that happens. But now you move up and you add the retailer or wholesaler plus retailer. And now guess what? Usually many retailers want what's called a keystone, which is 50%. So your $100 item, they want $50. And so that means you now make $5 for each unit you want, unless you had wholesaler, and then they'll probably want at least that and maybe more. And so now you're losing 10% on every unit you sell. So this is totally obvious, I think, when somebody has a slide like this and you're thinking, Peter, that's ridiculous. But guess what? Many, many people make this mistake. And so I just warn you not to do it and to look out for it. Okay, so when somebody is starting out and they don't have deep industry expertise, they need to do some research on what are the key ratios within their industry. So, cost of goods to sales is a very common one. Cost of labor to sales, food cost to menu cost. Most restaurants, about a third of whatever you pay is for the food, and 2/3 is for people, physical place, and overhead. What's the net profit, marketing cost to sales? Those are all things that you can research. But I'll give you a warning. So like marketing to sales, if you go in many industries, you'll see a number like 10%. 10% of revenues is a 7%, 10% is a normal marketing percentage for a typical company. But if you think about it, those are for mature companies, and those companies might be growing at 7 to 10% per year, namely not like a startup, which might be roughly doubling every year. So a startup might need 30, 50, 70% being spent on marketing in the first months or years. So I'll just give a caveat. It's great to research the comps, but also to sort of think about what's different about a startup than about the mature companies you might be getting that data from. Just pause. Any questions going along? Okay. Don't want to fill all the space with words and not give you a chance. All right. So here is not a rule, but a guideline. And the idea here is that there is a pattern that I see in companies once they launch, and it is something like this 10, 5, 2, 2, 2. It might even be 25, 10, 2, 2, 2, but basically the point is that, in the first year, that's when you can see a 10x growth. If you're doing $50,000 of business in 1 year, sure, it's 10x to go to 500,000 the next year, but it's very believable. That is something that happens all the time. It's increasing by $450,000 in a year is not that hard. And then to go 5x, so now you're at 500,000 to go to 2.5 million. It's pretty aggressive, but it can be done. And then after that, from 2.5 million, you might go to 5 million, and then I got twos here, but 9.8, and then 18. So it's going down every year. So and I said 2, but it might be 2, 1.8, 1.7, 1.6. It flattens out. So here's what's interesting: this 10, 5, 2, 2 gives you your classic hockey stick, right? But what does the year-on-year growth curve look like? It looks like the other side of a hockey stick. So you got 10, 5, 2, 2, 2, 2, 2 across there. So again, don't be dogmatic about this and say, Peter said it has to be 10, 5, 2, 2, 2. This is just a pattern in general. It will be a little different for every company, but the main thing is I once had a company who said, well, investors want 10x, so I'm showing 10x revenue growth every year. And I was like, whew, it was great if they could do it, which of course they can't. So I just give this to sort of show realistically what things typically look like. Here's one that I feel pretty strongly about how far into the future a pro forma should go. Does anybody have a feeling about how far it should be? Anyone? 5 years?
At least 5 years.
Yeah, at least 5. So I agree. I think 5 is a great number. But I have a lot of people who come to me and say, Peter, you can't project 5 years into the future. And so we think you can only do 2. And my answer is, well, those first 2 are probably going to be the wrongest years of the first 5. And so you really can't do any, is the answer. And in fact, life is full of risks and uncertainty, and maybe you should just not get out of bed in the morning, because if you can't do 5 years of projections, you can't even take the risk of putting your feet on the floor. So 2 years, ridiculous. 1 year, not useful. 5 years is the sort of a typical amount where we might be having discussions about exits. And so we are entering into an ironclad relationship that neither of us, investor nor founder, can get out of very easily. It is easier to get out of marriage than to get out of an investment. So given that we are in this ironclad relationship, we'd like to know how each party thinks this is going to go. So this is one way to do that. And 5 years, sometimes I have seen, in fact, I think I might even have a slide here. I'll show you where it goes to 7 years, because by 5 years, it was still in the flat part, and you've got to be hitting your hockey stick before you can have an exit. So that's that. Sometimes people have shown me beyond 5 years in order to demonstrate how much profit an acquirer could be making. And it sort of was a way of validating what sort of a revenue multiplier that they were anticipating in modeling their exit valuation. All right, so let's talk hockey sticks, because I have had people who've come to me and said, Peter, I'm not going to do a projection at all. It's going to look like a hockey stick. You know that, I know that. Why should I spend my time on that? And with that being said, I actually get a lot of information out of those hockey sticks. And yes, it does have to look like that. But I'll show you a few examples of things I've seen that people actually give me and what they're thinking. So here's one that is the optimistic startup founder. Once they launch, everybody needs this product. And so they're all going to go out and buy one. We'll have this rapid growth, and then when everybody has one, it will level off. This is wrong on like 3 different levels at least, if not more. One is sales never take off like this, especially enterprise sales. You know, you need reference customers, people do trials, then they start with just a division of their company and then they add on more and more. So, you know, it is very slow in the beginning. So you never do this. Also, it takes a long time to get into the channels in which you'll be selling. And so this assumes suddenly, bam, you are in 100 channels on day one. Never going to happen. But here's the other thing is this flattening shows a naivete on behalf of the founder about scaling. Because scaling, you know, kind of looks, you know, maybe like these little stair steps. You hit a little bit of a plateau and you've figured out, oh, at $1 million or $3 million, there's sort of an inflection point where you just can't really grow by doing the same things you have been doing since startup. And my metaphor I give is it's like riding a bicycle and you're in first gear and you can pedal and pedal and pedal all you want and you can never pedal faster than $3 million a year. And to get faster than $3 million a year, you've got to change into second gear or third gear or fourth gear. And that's how companies scale. And so that's why you see this sort of little bit of a plateau, you're pedaling as hard as you can, and then you change things by adding new channels, new product lines, new partnerships, new levels of systems and customer support. You move from a flat hierarchical structure to a more three-dimensional or two-dimensional hierarchical structure. All of those things are part of those growth inflection points that tend to happen around 3, 10, 25, 50, $100 million in revenue. Those are sort of some, not for everyone, but some common inflection points for those big changes. Last thing that is so wrong with this is, well, I guess this is maybe where we're going to be exiting. And what gives you the lowest exit multiple? Flat revenue growth. So they're basically saying, yeah, we're going to take this to the worst possible place and then we'll sell it for the lowest possible enterprise value. Okay. This is another thing I see, and this is programmatically driven financial projections, never a pattern actually seen in nature. So this is just not ever going to happen. So hockey stick, good on so many ways. It takes a long time to build those reference customers. But keep in mind, here's that 10x year-on-year growth. That's 10x, that's 5x, and that's 2x. So, you know, it's just kind of funny looking at how that works, but the smallest amount is giving you the best growth. Okay. All right, so here's how I think about proformas. I've talked about ones that are hyperbolically big at $4 billion, but there are also ones that are too small. And so this is like Goldilocks and the Three Bears, if you know this story. Goldilocks comes in, she tries the porridge. One's too hot, one's too cold, one's just right. Well, that's what proformas are like. And the ones that are too cold are too small. And what I mean by that is if you look at, say you're in an enterprise tech business and you're being conservative, so you show projections that are only $5 million at the end of 5 years. Well, that porridge is too cold. That number is very uninteresting to acquirers. It doesn't move the needle for them or give them enough impetus to acquire you. So that's tough. And then too big, it just is probably something you're not going to attain. And in some markets, you might outgrow the ability of your acquirers to acquire you, and then your only exit is IPO. It's not necessarily a bad thing, but just something to keep in mind. And then just right is that balance of growing rapidly. It's still really hard, it's aggressive, but puts you right in the sweet spot when you look at where you're going to end up at the end of 5 or 7 years when it's time to be acquired. So some of those things that I look for when I'm watching a pitch is, you know, roughly in the last 3 years, 2-ish X year-on-year growth, and then more in the beginning. This one is important. Expenses grow proportionally. Sometimes what I see is somebody's doing the hockey stick, and then the expenses are just flatlining. They're just kind of going along. And this is super common. And And it's an indicator that the founder is not really thinking about what the true cost of offering their product or service is. And I've seen some where they show 25 million in revenues and they still only have 5 employees. And frankly, if you have 25 million in revenues, you probably have 5 people just in accounting alone, much less sales, manufacturing, distribution, warehousing, all of those things. So that's always a big red flag. Exit year valuations times multiple, does it make sense? And then, just right. So let's talk accuracy. I will say probably 10 to 15% of pro formas I get when I actually make an investment, the company exceeds the projections. Does happen, but it's the rarity. 85% of the time, they might be close, but they're going to be, somewhere under what they projected. And that's normal. That's the beauty of entrepreneurship. People are optimistic. They're setting high goals, achieving still pretty good goals, and that's great. So nobody really expects the pro forma to be 100% accurate. And, I tell investors this all the time, but invariably, 2 years later, there's going to be some investor who says, you didn't hit the exact numbers you told us you were going to do. And, you want to say, cool down. It's okay. Let's see how we can help, not, hold somebody to not having perfect projections. The one thing I like is, though, even if the numbers are different, the key ratios are the same. Expenses are going up at about the same rate as growth and so on. Uh-oh. Oh, my battery is running low here. So get ready, Olga. All right, so here's one that I thought of I'd share with you just because what they did was they showed the company who created this is the green line here on the pro forma. And what they did was they were actually able to get the numbers of one of the incumbents in their industry and show the red line, which was how that company grew. And so I thought that was kind of neat. And I saw that the incumbent kind of had this pattern, and then this company had, scarily, almost the same exact pattern. But it made it somewhat believable. Except for the fact that this company is called Blueprint Brewery, and the comparable one is Goose Island. You may not know this beer, but it was one of the first craft beers to be distributed on mass markets. And so they were able to come in and grab a huge portion of the market. Craft beers now take almost half of the refrigerator space in liquor stores in the US. And so to have yet another craft beer is going to be really, really hard. So matching what somebody did 15, 20 years ago is going to be near to impossible. The other thing that's interesting about this, by the way, is here's year 5, still almost flat. And this really showed that, in fact, the projection would need to be at least 7 years before this would be a company that would be, it would be a good time for them to present for an exit. All right, so I'm giving you a bunch of percentages here, but 100% of the time, when I hear these two words uttered together, conservative estimates, I don't believe the pro forma. It's just kind of uncanny. Nobody has ever said conservative estimates, and then I thought, oh, well, they are. That's pretty good. So it usually means to me somebody didn't do the work, they made up a really large number, and then they cut that in half, which was still ridiculously large. So using those words, conservative estimates, is not a way to convince investors that these are reasonable numbers. And in fact, if anything, it's just the opposite. All right, so let's dig into some of those different tabs that people might talk about. And obviously, the ones you want to have the most insight into are the ones that have the most dollars involved. So headcount is going to be the biggest expense for just about any company. And if it's just one single line item, when it's combined in with taxes and benefits and all of those things, I can't even tell how many employees they have by year 3. So I like to see a separate tab, and it's going to, it's going to start with just a few people and then more and more and more as the company grows. And it's going to be really interesting to me to analyze, well, what's the ratio? When do they wait until it's totally painful before hiring the next salesperson, or before moving to a full-time in-house accounting department, or putting up customer success employees, that kind of thing? It's really fascinating to look at how people think about that and how they're thinking about their compensation plans. Are they paying market rates, or are they using a lot of their equity in terms of stock options to incentivize people to work at below market rates? Those are all indicators that we can see by looking at headcount. And I'll just pause to talk about strategies for using equity to pay employees below market rates. There are a lot of people whose spouses will not let them work for startups because sometimes your payroll doesn't show up at all, or your chance of having a job a year or two down the line is fairly small. So, but people who do work for startups and believe in the startup, they don't want just market rate salaries. They want to have some part of this action. So, when we do the proformas, we want to build in some sort of equity sharing plan. And tomorrow, when we do the valuation models, I'll show you how we do that and how we think about what percentage it should be. But basically, the teaser is, at each round, I see between 5 and 10% of the equity going into those employee stock option pools, and that people will be thinking about how to use those not just to attract and retain employees, but also to almost make the employees investors in the company. If you think about it, if you pay somebody $10,000 less per year, but you give them, $20,000 worth of stock at today's valuation, basically, the employee is investing in your company at about, getting about a 50% discount on the stock. And we'll talk more about that tomorrow. All right. So second biggest expense is going to be marketing. And so we're going to want to see, some sort of detail. I like, so instead of just being sort of one big lump, maybe a company has 2 big trade shows it does every year. Well, I'd want to see some expenses coming, building up, deposits or printing or trade show booth development, and then the big chunk of money paying, during the month of the show, and then nothing, and then building up for that next show. That shows me they're really thinking about, in detail, about what their marketing is going to be. The other thing is here, I mentioned this earlier, just looking at how they're thinking about what percentage of revenue is going to go to marketing, not probably the 7 to 10% norm for the industry. Mentioned this, if the pro forma says you're running out of cash, you need a new fractional CFO. But let me talk about fractional CFOs. If you're starting a company, you probably can't afford $200,000 a year for a CFO, chief financial officer, and you should outsource your accounting, which might be just a few dollars a month. But having a good fractional CFO is a great idea, and they should be able to keep you from having stupid mistakes like running out of cash on your projections. It's easy to run out of cash in real life, but it should be impossible to do here. Expenses, tracking with revenues. Here's one thing. When I say be wary of net profits exceeding 20%, there's the MBAs in the room will think, well, why? Isn't it good if net profits are exceeding 20%? And those of you who were here yesterday when we talked about exit strategies and enterprise value creation, we talked about if you have even $1 million left at your bottom line because you have extraordinary high net profits, that $1 million you could invest in marketing, so it becomes not a net profit, it becomes an expense. And that marketing, we probably all agree, $1 of marketing can create about $5 of sales. So you could get about $5 million of sales, And if you're in a 5x exit environment, 5 times top line revenue exit environment, that $5 million of additional sales might add $25 million of additional enterprise value. So this, I say beware of net profits. Net profits are good, don't get me wrong, but top line revenues that can be used in those multiples for setting valuations will be good. Many companies, of course, if you do have positive cash flow, will increase from 5 to 7, 8, 9x what the top line revenues are because they're seeing that you're creating those revenues. So, not a hard and fast rule. All right, in the end of the day, all of those things need to work together. The valuation, the amount being raised, the pro forma, expenses, all of those things. All right, you all heard of this concept of J-curve. There's 2 ways of using it. One is for funds. A venture capital fund has a huge J-curve. We invest money, it all goes out, it looks really bad. Right here, you've got a DPI of 0, and it's not great. Dollars paid in capital, but this belly of this, if you're just drawing your negative cash flow for a startup company, this is where we start asking ourselves, well, how much should we raise? Oops, there it goes. So, but you've all memorized what that looks like while Olga and I do a fast switch of camera or of computers. So the idea here is to look at what that big gap of cash is, and this is why venture capital exists, is to fill that gap, right? And the amount of the total raises that you project should come to about that amount of net losses during that period. And then the trick is going to be to figure out how many raises will it take to get out of the belly of that J-curve. And it could be 1, could be 3, or you might never get out. You could be like Uber or WeWork and never get out of negative cash flow. And all right, that looks great. Perfect. All right. All right, so, and I had this slide yesterday, but can't stress it enough, that when we're looking at the pro formas, the principles that we put into coming up with these projections use venturenomics principles as opposed to MBA-nomics, standard business economics terms. So this concept of how value creation works is super important, and we need to understand that most of the value that we get in a startup company is going to come from being acquired or having an IPO or whatever the case might be. And so thinking about what are the drivers of value at exit are going to be the most important things we think about in our pro forma, and what activities and what results will we need to be most attractive and to get the largest multiple possible. All right. So pricing and margins, this is going to be one of those things where you can struggle with this all you want in your pro forma. It's something that obviously marketing classes and workshops spend a lot of time on. What I like to see is just that the company isn't making price its primary strategy and its differentiation from other products. If it is, it's a race to the bottom. Nobody's going to lose, and most importantly, no company, no enterprise level company is going to want to buy the market loser in terms of low price, because enterprises know they need to have good margins to keep their stock prices up, and they're going to be looking for those things. That being said, it's great if you want to do penetration pricing strategies, start off in the first 3 months, 6 months with introductory pricing, to get lots of reference customers, people using it, buzz, word of mouth, lots of positive reviews, that kind of thing. Being too conservative is just as bad as being too optimistic. So something like at least 10x is the return you should be planning for investors. All right, so let's talk about top-down versus bottom-up. And the main message here is, my recommendation is you use both. But whenever anybody starts with top-down, and when I hear somebody at the startup phase talking about getting 1% or 5% of market share, well, that's kind of weird to me. Because at this point, you're at $0 in revenues and you're talking about being in this multi-billion-dollar market and having some percentage of it. That's great. It can be an exercise that you can use to test against your bottom-up strategy, but frankly, it's a little premature to do that unless the reason you're doing it is you're thinking about what the needs of your acquirer are and how they would want to, they could pick up an extra 5% of market share, how that might be an extraordinary value to them. So, so the bottom up is this is the most believable way for somebody to produce a pro forma. And one reason that I encourage companies to have at least some revenue before they do their first raise is if you don't have any market data, then it's really hard to do a believable bottom-up strategy. But if you do just $5,000 or $10,000 a month in sales, now you can say, oh, well, here's our cost per lead, here's our conversion rate on leads, and here's our cost per sale, and we can start to say, all right, as we scale up, these are the numbers we're seeing, and of course, the entire job of startups is to start off with sort of a high cost of acquiring a customer and a low LTV, lifetime value, and then during the course of angel investment while going to Series A is to shift that ratio from low cost of acquiring a customer and high lifetime value. So that shift is what angel money buys. Just simply that. Low CAC, high LTV from the other way around. So we start with probably really crappy numbers with high CAC, low LTV, but that's what we're getting. So it's believable, and that's where we have to start because our money is going to go to make that work. And so if you're projecting some really optimistic ratios, then you're going to run out of cash and the company will fail. So here's an example of a company that we actually didn't end up investing, but got close. They had a physical product. It was sort of a accessory PC, phone, pad, tablet type accessory product, and they were doing really well with it, growing really fast. So they were seeing sales of about $1.5 million a year. So they had good traction, great manufacturing, distribution. The unit price was $75. And so they were able to say they were in 100 stores. This was in Target. You might know it's a retail. And this was interesting to me. They sell 2 units per week per store. It seemed like nothing to me, but actually that was apparently really good as far as Target was concerned. So that came to 20,800 units a store. So that's what they do now. Well, now we can take this and we can, oops, don't have a next slide. Now we can project and say, all right, well, maybe we can do either get into 150 stores or we can do some sort of promotions to sell 2.5, 3 units per store, whatever it might be. And then we could project that we might sell 2.5 million, 2.75 million in the next year. I would believe those numbers. That would be highly, highly believable. They're already in these channels and they can just do more of that. So that's the best way to do it. The worst way is this, 1.4 billion people in China. I've seen it, 1%, so that gives us 140 billion a year. But here's something else that's in between that can catch you off guard, and this is classic, is you have a comp that's not a real comp. And by that I mean, you're saying, well, we're gonna create a coffee shop and the average Starbucks does 3.5 million a year. So, we should be able to do half that, right? I mean, we're not Starbucks, we know that. But, 1.75, does that make sense? No. Probably 175,000 is good for a startup coffee shop, right? I mean, that would be a great year for somebody starting. So comps that are not comps can be deceiving. And not intentionally. And I say deceiving, not meaning the founders lie when they put that in there. They're doing homework like we told them to, and then bam, there we go. Okay, So let's talk TAM for a second, because this is probably one of the most misunderstood areas that I see. And, you know, there's really just something simple that I want to know with TAM. Is this a big enough market that there's a place for this new entrant, hopefully in a blue ocean strategy where, you know, it's not competing on price or whatever? And also that there are incumbents in that market, existing corporate players who have sufficient capital to buy us. And I did a accelerator program for the hemp industry. This was a while ago, 5-6 years ago, before hemp was even legal in the United States. The entire market for hemp at that time was $500 million a year. And people were pitching, oh, we're going to be acquired for, you know, $200 million. I'm like, really? 40% of the entire industry top line revenue is what somebody's going to pay you? Probably not. So understanding, you know, TAM, and the reason we want to see it's big is just to see that there's good acquisition possibilities there. People, I will say a huge percentage of people misuse these numbers, and they don't understand what a total addressable market is. And the way I define it is, if everybody who sells something like your product, you know, bought your product, that would be the total addressable market. And so the confusion people think of is the TAM is the industry. So TAM is not the industry. So for example, we had a company who was making construction management software for large construction projects. And they said, yeah, we're in the $1 trillion construction industry, or, you know, whatever it is. And we're like, yeah, but there's no, you know, builder out there who's thinking, oh, should I buy nails and plywood and 2x4s or the software? No. So it is not that is not part of the TAM. Their addressable market is the construction management software industry, which might be, I don't even know, 500 million, 750 million a year. I'm making that up, but some much smaller number than the entire construction industry. So understanding that everybody else who bought somebody else's construction management software, that's your TAM. And then of course, you know, you've got your TAM, SAM, SOM, and those are just smaller and smaller things. Yes?
One question, if we don't know the TAM of the industry, how can we, let's say, get information about that? For example, you mentioned the construction management software. How can we get information about what's the size of that thing, and how relevant is the TAM in the whole picture?
Yeah.
Number of programs, files, license. How many this software?
Yeah, but how we cannot find information about that?
You can find the information from the companies that you
So, and what is your industry?
Marketing automation, please.
Okay. So here's the thing. What I do when I'm just sort of checking on this, I mean, I start with probably what all of you do. I just look for total market size something. And, you know, 8 times out of 10, I get like 3 numbers that are actually wildly divergent. And I have to decide which one is going to be the one I'm going to use. But the main thing here is it doesn't really matter, you know, that this is a $6.32849 billion market. It's just, this is a $5 to $8 billion market. That's good enough, you know. So I wouldn't get too tied up in that. There are other indicators, you know, like you mentioned, if you can find some leading indicator like numbers of licenses, numbers of companies. Frankly, that's pretty hard because most of these are private companies. But other places I've been successful is almost every industry has an industry association. And that industry association typically will collect data from its members and produce annual reports of, you know, what they're doing. And so they won't, you know, release any individual company information, but they'll be proud that they are the association of the $10 billion, you know, whatever widget company. And so there are typically ways to do it. But here's another example. In Colorado, we have a company called Sphero, and it's a robotic ball. I think of it as an expensive cat toy. You can move it around, this ball rolls around. And there was no TAM for that. I don't know, maybe it's in the cat toy market, whatever, but it's this robotic ball rolls around. So they had to kind of create their TAM. And when they pitched, they said TAM is 0. And then they used other rationale for how they were going to build that market. And that was interesting. Another example of that was Fitbits. 15 years ago, nobody had a fitness tracker, and now everybody has a fitness tracker. And so Fitbit said, yeah, TAM is 0, and then it turned out to be a multi-billion-dollar market. And they just had to say things like, well, we know there's this many people who exercise or who are doing these various things, and we think, based on whatever, these people spend money, do marathons, whatever, that a quarter of them will buy Fitbits. So you can kind of, and it's never going to be a super exact number, but you want to give some sort of just a story about how big this could be. So, and of course, everybody and their dog came in and joined the fitness tracker market. Now we all have them on our Apple Watches, and it's ubiquitous. So main messages there is industry reports. Look for other weird KPIs that you can do bottom up, or just think. Really, the whole reason we have this is to develop a good story about how this is going to be growing. Yeah.
Is it okay if there's no data? You took some similar company that already raised funds. So what's the investment they raised, and somehow to try and come to these numbers?
That's always a valuable way. I wouldn't use that in my TAM discussion, but I would use it in my valuation discussion. So, like yesterday we talked about, we want to look at the exit data, but if you're in an industry where really there are no good exit comps, and you do have a number of people who have raised interim financings, you can say, well, look, these guys just raised 20 million at a 40 million pre, and they have 28 employees, and they're doing 5 million in revenues. So we think, given that comp, we could be this. All right, so TAM, just one last word. This is the one slide. If you leave it off your deck, I'm probably pretty good with that. The other thing, by the way, about TAM is there's a lot of things like, there's a lot of industries we just know are big. You don't need to talk about TAM if it's obviously big. But sometimes when people have a fairly obscure little medical device, I kind of need to know how many of these procedures are done per year in order to determine, because I have no idea how many times things are stuck up people's noses to do whatever they do, and I need that kind of data. So probably maybe a third of the time, I have no idea, even close, about how many something there is. All right, so here we go. This is highly imperfect. There's a lot of speculation in this. So why do we want to see the proformas from startups? Man, let me just tell you, I said I get a lot out of this. Well, what do I get? And one thing I get out of seeing the proforma, it's not just getting numbers that I can use to figure out what an exit valuation might be. It's not just sort of seeing the details, seeing if it all hangs together, but really a lot of it is seeing how the startup thinks, how the founders think. And as an investor, I want to invest in people who will have the fewest surprises. Because in my experience, when companies don't do well, it's, they're well-meaning, but something surprised them. And if they are very detailed and they have thought things through, their likelihood of being surprised is diminished, and the likelihood of my investment being successful is increased. And so when I'm looking at the level of detail, I'm looking at what those surprises are. Now, that being said, and I'm going to show you some different proformas in a minute, but there, I talked about, you could have the proforma, that's income statement, balance sheet, stat cash flows, and other things. There are proformas that are actually, well, I guess they're called models, but they might have 50, 60, 100 tabs on them. And they are weedy gardens of various types of data that reference things and way different tabs, and so just having tons and tons of detail is not necessarily a good thing. Sometimes people get into such detail that they lose sight of the big picture. And so if I see something with 100 tabs where I can only get through it with a guided tour from the CFO, maybe this is not a good sign either. So there's a balance here. Oh, and going back to that company who sold the $75 product, had 1.5 million in sales. So they had one thing in there that I loved, and that was they knew that Target was going to charge them $5 a unit for a marketing development fund. For a $75 product, that's a pretty big chunk of the price. That's, whatever, 6.5%. So the fact that they were not going to be surprised by that additional 6.5% charge was important. Now here is another one. I think probably all of you, if I asked, know what burn rate is. But it is negative cash flow basically. But invariably, I see people use it incorrectly. And the reason that they use it incorrectly is when a company starts and it has no revenue, every dollar it spends is burn, right? So if you have zero revenues, you spend $10,000 a month, you're burning $10,000 a month. And then they develop a culture about, oh God, that's our burn, that's bad. And then they start to get 5,000 in revenues and 10,000 in expenses, and they don't adjust their internal language or even their accounting to say, oh, well, we're burning 5,000 a month because we have 10,000 a burn, or 10,000 of expense. See, I just did it. 10,000 of expense, 5,000 revenue gives them a $5,000 burn. So invariably, people will mess this up. And just the other day, I got a newsletter from one of our CEOs, and she had put that she had this burn rate, and I had to write back to her and say, you just told all of your investors that your burn was about 5x greater than your actual burn was. And so she went and issued a correction. But anyway, so I just put this up to make it clear. So guess what's missing from so many proformas is the subsequent rounds of funding. And this, of course, is what we'll do tomorrow when we do the capital stack strategy workshop. But for some reason, people who are putting together proformas will often say, okay, here's our month 1, month 2, month 12, year 2, year 3, year 4 revenues and expenses. But for some reason, the amount that needs to be raised is left out. And that's, of course, the scenarios where we end up with that negative cash on the cash flow statement. So I actually can't even imagine why people don't do this. This is usually one of the number one questions that investors ask startups after the ask slide on the pitch deck. You're raising $1 million today. Well, what's your plan for the next raise? And so, and I'm surprised how many founders haven't thought that through. So certainly you need to show what those rounds are, when they happen, and what they're going to do. Yeah?
This will be shown in cash flow and balance sheet.
Yep, exactly. So not on income statement. So it's cash flow and balance sheet. Exactly right. Okay. All right. So I've said this a few times, but just to be clear, without a pro forma, either one that I get from a founder or one I've had to create myself, I have a hard time doing valuation. And we've talked about different valuation methods we use, but the DCF, discounted future cash flow models, require me to think about the exit scenario. And of course, for me to value the exit, I need to know what the revenues are going to look like, and then work on the multiplier and come up with a number that way. So having a pro forma, if I can't do valuation, I don't know how I'm going to invest in the company. I need to figure out how much it's worth, and this is one of the best tools I've got, however imperfect. All right, so wrapping this up then, where do you start? If you're starting, just basically researching. If you can find other proformas, if you've got peers in the market who are not competitors, things you can do to share, get those key ratios. There is a ton of research, and these are just a few places. Again, we'll share this deck with you that you can go. All right, so with that, unless there's questions, I'm going to show you some different proformas and just sort of walk you through what I'm thinking about when I look at them. And this will be, for those of you who couldn't raise your hand for having seen 3 or more, now you'll be able to say, yes, I've seen 3 or more proformas. Does anybody, by the way, while we're going through this, does anybody have a proforma that they would like to share and get sort of a group critique? Sometimes people do that. It's fun. I know it's scary. You weren't warned about this. But if somebody does, and you want to share it, I'd be glad to, all of us could weigh in and say what we think about it. All right. Well, think about that, and we'll walk through a few of these. Okay. All right. Oh, these are going to be hard for you to see. Let's see what I can do here. All right. So, actually, I don't want to start with this one. What's that? Med device. These are different industries as well. All right, so let me start with this one. Yes, thank you. Still not readable, is it? Sorry about that. Now I've lost my bar.
You can just go through that corner and then zoom in the corner.
Oh, thank you. That's what I wanted.
That's what I was trying to do.
Okay, good. Okay, cool. Yeah, I know how to run Excel. All right. So let's just talk about what this is. All we got from this company was this one sheet. All right, so this is the classic just income statement. Let me just say, I don't think the color gives me any information here. So just, I could see if you're trying to show things, if your bottom line is negative, you make it red, that's fine. But this really doesn't help. And especially when people are presenting this up on a screen, it makes it even harder to read, this black on green. Not good. So colors, spend more time on the numbers, less time on formatting. So this one is a sample medical device company, and all they gave us was top line revenues and expenses. So they put in, this is not, I said it's sort of an income statement type model, but it's not actually truly that, because it's got things like KPIs, like how many hospitals are using this solution. And that's okay. I like to, it actually helps me as somebody to say, oh, well, here's, the how many hospitals are doing this is going to be a driver of what their revenues look like. And then they have all of these assumptions. How much are they selling it for? What are their COGS, cost of goods sold? All of those things. That's kind of useful. So one reason I wanted to show this as a sample is we start to see all these weird hybrids of financial statements. So this is okay, but here it's got, the total addressable market at the top. That's not clearly a part of your traditional income statement. And sometimes what these turn into is income/balance sheet statements, where somebody's just reinventing the entire financial statement. And even worse than that, that's not so bad if they're trying to, for whatever reason, consolidate into one page, but I don't know why you would. even worse than that, sometimes, people will put the profit or loss at the top instead of at the bottom. And those of us who are used to reading financial statements have to kind of turn our heads upside down. So reinventing even the structure of how financial statements are reported is definitely a red flag. All right, I'm not going to go too much into analyzing this except to just show you a couple of key things of what these guys did. So here they have all these assumptions, and then their sales are going from 1.150 to 2.7. That's a pretty big jump. 2.7 to 6.7 the next year, so that's 2.6x or so. 6.7 to 13, that's about a 2. 13 to 22, that's about a 1.7. So those are okay ratios as I look through and I'm analyzing that 10, 5, 2, 2, 2. Sure, it's pretty aggressive. Do I think they'll really get to 22.5? Yeah.
Why the total value market is growing 10 times? Because it's the growth value.
Yeah, but in 1 year it grows 9x. That's from 2022 to, but here's something, I wonder. They don't really say. Am I doing it wrong? Okay. Oh, maybe because some things, yeah, I don't know what happened there, but that's definitely strange. But again, strange to put the TAM in anyway. So here we've got cost of goods sold, gross margin, then operating expenses. These are fairly typical. One thing I don't see here is sometimes you'll have regulatory costs going through regulatory processes, and we don't see that here. So that's a little strange. And then grants. Oops, it went away, but it totally went away. I do want to call that out, but in a lot of medical things, grants are driving the company getting to market, and we talk about grants as being good because it's non-dilutive funding, and yet a lot of times we'll see people getting a grant, and then then all of a sudden the valuation's going way up, and I'm like, well, that seems like dilutive funding to me. So there's two ways of looking at it. Certainly, if you have a company and you decide that the value is $5 million and they get $1 million grant, and so you have $1 million of cash, it's absolutely fair to value, this is kind of jumping to tomorrow, but it's fair to take that grant and value it at $6 million. But if they've gotten $10 million in grants over the last 5 years and they've spent it all, then it is not fair to use that $10 million as part of the valuation. That is just money that went away, and that's the purpose for grants, because VCs and investors won't invest in that $10 million. It's too risky, too early, and the grants exist to allow novel medical devices, not medical solutions, to come to market. All right, and then just let's see if there's anything else here.
Grants should be revenues.
Cash proxy, they call it. So, yes, grants should be revenues, absolutely, because they're not being paid back. They should be up on the top line. And great to call them out, but not to have them be like that. Oops. Do you want to drive for me?
Yeah.
Thank you. I'm trying to, all right. So let's look at the next one.
Which one? This one?
Yeah. All right, so here's, this one is, so on the spectrum of super simple, just income statement and scary model, this one's about 3/4 of the way through. It's got a lot of detail in it, and it's actually kind of nice. There's a kind of a logic you can follow in it, and you can see what they're doing. It's not necessarily organized in a super great way, but it allows us to dial in and see what the company is thinking about with some of its numbers. So here's sales and revenue assumptions, looking at how many units they're going to sell, how much they're going to cost, and all of that. They're looking at pricing. You can scroll further down. And then here we've got, it's a little weird to call it one product, two products, but this is sort of mixing in the product mix, which I said I like to see separated out. And then now they're moving into sales and staffing and numbers of salespeople. This is getting to be sort of a lot of data for one sheet. You'll see later that a few sheets later they start to do staffing, for example, again. So here we are looking at the numbers of people. I always wonder about the 0.33. That's just sort of a not very good salesman. We all have one of those. And then keep going. Then new accounts by year. You get the idea. So, you know, we're not going to pull this one about too much, but let's go and look at operating expenses. Okay, so this should look like traditional expense lines. One of the things about this is some people have way too few operating expenses in their projections, and you can't really get an idea what it is. And other people have, like I think this one might have Zoom for $16 a month. That's too much detail. You know, you don't need, you know, that Zoom as a line item. Maybe you have software as a line item. So, so we can scroll again. So this is operating expense. So we had staff, we got product development, marketing and sales, bookkeeping, legal, patent, rent, gifts. That's a weird one. What's gifts? I mean, if it's $200, it's probably not, you know, at a level that we need to have a whole line for it. So, and then now we're doing some other weird things. See, this is not going to show up. If you put this into QuickBooks, you're not going to get a report that would report against this. So what we're seeing is people who are doing a lot of their own work, and then they've decided to share it with us, for better or for worse. But it is definitely not a GAAP, generally accepted accounting principles sort of pro forma. All right, anything else? Do we have more? Scroll. That's it. Marketing, professional services, yeah. It's a little bit redundant. All right, so we can go quicker now. We can look at their staffing plan. So this is good. They have the people, they have what the salaries are. We can sort of check, are the salaries making sense? And are they building in all of the overhead, which is going to be typically about 20% in the US anyway, mainly because we have such stupid healthcare costs that we'll go for each of these. So this is actually pretty good, and you can see total staffing. Yes?
You mentioned before that if the budget is more detailed, it's more convinced for you to invest in the startup. And now you're telling that there is too much details if you put Zoom in.
Yes.
So?
That's that continuum. I want it not to be just a few big buckets, but I also don't want to have a line item for every damn thing. So there's sort of a sweet spot in between. So you're right, thank you. That's what, frankly, in venture capital, almost everything is going to be a balance between extremes of one thing or another. And this is one of those, at least for what I like to see. The weird thing here is, and you know, I use this as an example because I have a hard time really wrapping my head about what it seems like. Didn't they have CEO up there earlier, and now I'm seeing it again, and I have to figure out, you know, why do they have them in there twice? Again, it tells me how these people think, and maybe that they are not as clear as they could be. If that makes sense. All right, let's just look at a couple other tabs. Take a look at the cash flow tab. Okay, so here's one thing they do that's nice, that they give me the whole year, but instead of going 2020 and then usually you'd expect 2021 over here, now we're starting the next year, you know, down here. So it's kind of good. I guess you can compare year over year this way, but I personally expect to see things, moving to the right for timelines. So I will give them credit for never running out of cash. So that's a good thing. On paper, exactly. But in some cases, here, one thing that I do like to look at is a lot of companies will take themselves down to where they have almost no cash before the next raise. And if you're driving across a desert, do you take your car down to empty, before you get to the next gas station? Probably not. And so I'm going to look at how the company thinks about its reserve strategy. And I want to see something like 6 months or so of reserves by the time the next raise happens. I will just say that some startups raise money every 6 months. And so, this is more of what we'll talk about tomorrow, but this idea of the increasing pace of raises means that if you raise every 6 months, you're probably not going to have 6 months of cash at the end of that time. And one reason people say that it's really smart for startups to raise every 6 or 9 months is that they can minimize their dilution. They're just raising, build value, and then raise a little bit more at the next higher valuation, and so on. There's a reason why the normal cadence for companies is around 18 months. And that is, first of all, so you're not raising every damn day and you can run the company, which is one thing. But the other is, so you're not running that extraordinary risk of running out of money. I think if you somehow have a guarantee of getting that funding every 6 months, then that's great. You can minimize dilution, but I would never invest in that company. All right, so marketing detail. One thing I like, by the way, about marketing detail is we ask companies to talk about their CAC, the cost of acquiring a customer. But if they're in a multi-channel environment, all channels have different CACs, right? And so how are they thinking about which channels are worth it for them to be in? So they might say, oh, it costs us $10 to acquire a customer, but some might be $2, some might be $15, and it might still make sense, even though there's a 7x difference in those costs of acquiring a customer, it might still make sense. But I certainly like, in a thing like this, to have some sort of insight into what the CAC is for each channel that a company uses. Yeah?
I have a question regarding the marketing budget. Before we raised with Howitzer, we were negotiating with another VC, and they sent us this proforma blueprint that we needed to fulfill. And basically, they asked us to put every marketing channel and to try to guesstimate customer acquiring customers. And it was the hardest thing I had to do in my life. And I personally don't believe in these things, especially if you're a pre-seed company or a company that still hasn't validated its product market fit and it's still in the process of finding it. So what do you suggest us to do when, let's say, we're raising again a pre-seed loan or a seed loan or whatever, and they ask us how do we budget this whole marketing thing? How can we predict this marketing thing? For example, let's say we are doing growth hacking and we're using influencers. How can we predict how much it would cost us and what's the cost per acquiring customer?
Yeah.
That whole.
So usually it's a surprise what your cost of acquiring a customer is once you actually engage with a channel. I mean, your guess is, if I were doing proformas, I would probably be way off for what, just guessing what it would cost me to acquire a customer. So I agree with you in that regard, that it might be difficult, but I also think you can take a relatively small amount of money, just a couple $1,000s, and that might be a lot for you now, but bear with me, and you could do some simple marketing tests, maybe just a few $100s with each channel, and get an idea for what the number of leads and conversion numbers would be. And then, of course, it's going to be way off. You're going to continue to improve it, but you're going to have to do that in any case at some point. So if you can do it beforehand, then it makes your numbers a lot more valid, not just for your VC, but for you, to figure out how much you're going to need to raise to hit your revenue numbers that you need to validate for your next round of funding. So, yeah.
Some
sometimes even the marketing is not a problem, or maybe the sales team is sometimes a problem. And you have to work on both sides to evaluate what is what. So maybe you have good input of leads, but you have nothing coming out of on the end. And maybe it's not the problem with the leads, maybe it's problem with the funnel.
Yeah, I was asking specifically for marketing because let's say when you're entering below, you don't know what is the usual marketing process, especially with software, with something that changes the way of doing things. So you don't know the marketing channels that are going to work for you. You need to do like set up the hypothesis and test it out and see how it goes. And usually these hypotheses cost more money than you can afford. So yeah, that kind of thing. This was a question for Prezi, not for City, because for City you did have a problem with it, especially for Prezi.
Yeah. Well, I hear you. I hear what you're saying, and I agree. If you have zero money and you can't do it, it's a good idea to do even tiny tests if you have a little bit of money. And if you don't, I would just be super honest with the VCs and say, I'm going to give you some super speculative numbers based on what I see other people doing as cost of acquiring a customer. I mean, when the rules have changed, like all of a sudden everybody quit advertising on Facebook earlier this year, because the rules changed and suddenly the CAC became different for everybody. But you can read about in general what CACs are for other people. And by the way, I really do appreciate your comment about you can create a beautiful funnel that creates all kinds of leads, and if you can't get people who are actually going to close it, and sadly to say, I've seen a lot of companies who that's the case, then that all that funnel is for naught. It's worth nothing. So anyway, for your VCs, I'd say, look, we haven't done the tests. That's why we're coming to you for money. And here's what we find other people are getting for CACs. And so just to be totally transparent, it's fully speculative. The other thing you could do is pursue like a $5,000, $10,000 friends and family round, something like that, or get a credit card and use something like that to validate, because guess what? When you validated, say 4 or 5 channels and you have some actual data for CAC, and maybe not even LTV at that point, but you've got that, then the value of your company can be higher, because now you have one less giant risk, right? And you come across as more established for the investor. And I'll just say, a lot of people are afraid of using credit cards, but if you figure a VC is 10x in 5 years, that's 58.5% a year. So suddenly 18% for a credit card looks pretty cheap. The one difference is if you go belly up and your company goes out of business, the credit card is still yours. So you still owe that money. Whereas with VC money, you walk away, your personal financial situation is still good. Ours is not. So that's the rules there. But if you're very confident, then sometimes just getting that little amount from a credit card is a good way to do it. Okay, so that is what I've got for you today, and I know that it is an hour and something earlier than we have budgeted for, but for some reason we just did one work session today. So I am happy to answer any other questions you've got, but otherwise that's our content for you. Okay. All right, I will hang out, and if folks want to ask any questions, I will be around.